This is the Capitalism and Freedom in the 21st Century podcast, an official podcast of the Hoover Institution Economic Policy Working Group, where we talk about economics, markets, and public policy. I'm Jon Hartley, your host. Today, my guest is Eugene Fama, who is a professor of finance at the University of Chicago Booth School of Business. He's widely regarded as the father of modern finance, as his research has really truly built the foundation of the field of financial economics as we know it today, for which he was awarded the Nobel Prize in Economic Sciences in 2013. Welcome, Gene.
Thank you.
Gene, I want to first get into your early life. You were born in Boston, and you grew up in the Boston area.
Right.
All your grandparents were Italian immigrants from Italy, as I understand it. And my understanding is that you were actually named after one of the Pope Eugenes. You were an athletic all-star at the Malden Catholic High School. You're in their Athletic Hall of Fame, and it's in the Boston area. That's Middlesex County. You studied Romance languages as an undergraduate at Tufts. I mean, how did you get interested in finance and decide to do an MBA and PhD at the University of Chicago and arguably become the greatest financial economist ever?
Well, my initial intent was to be a sports coach and a French teacher. So I took Romance languages there my first 2 years at Tufts. And I was getting bored with it, so I took an economics course. And I loved it. And the professors loved me. They were reading my exams to the class. So I immediately switched and took all the economics courses I could in my last 2 years. Then when it came time I said, I think I want to go to graduate school and get a PhD. And my professors, who were all Harvard graduates, I said, I don't want to go to an economics department. I want to go to a business school. And they were all Harvard graduates. And they said, well, don't go to Harvard. Go to the University of Chicago. They have more of an academic orientation there. And so I applied, and I never heard back from them. And March came along, and not having heard back, I called, and the dean of students answered the phone. The dean of students doesn't even have a phone now because he's too important. But he answered the phone and talked to me for a while. He said, I got some bad news for you. I don't have any record of your application. But he said, what kind of grades do you have? And I said, well, basically all A's. And he said, well, we just happen to have a scholarship for somebody from Tufts. Do you want it? And that's how I ended up at the University of Chicago.
Wow. That's amazing. And I mean, in terms of your sports interests, it's wonderful. I know you play a lot of golf, and you're still playing a lot of golf over the years. So it's great to see that you've maintained some of that initial interest in sports as well. I mean, you spent your entire career as both a graduate student and professor at the University of Chicago, and you arrived there in the 1960s, and there were a lot of other folks who were there at that time. I mean, it was truly, as I understand, a foundational period for financial economics as a field. There was so little done at that point in time. I mean, my sense is that Harry Markowitz had just written down the mean variance model in the 50s. Things like the CAP-M were sort of just being written down by folks like Bill Sharp. But at Chicago, you had folks like Merton Miller, Harry Roberts, they were your advisors. You had folks like Myron Scholes, who you advised, and other folks like Dick Roll, many others who are really foundational to financial economics and developing the field as it was so early. I mean, what was it like doing financial economics research at that time? Obviously, personal computers didn't really even exist at that point in time. How would a young Eugene Fama even do financial economics research in the 1960s? I mean, what sorts of tools were you using, and what sorts of tools were being developed?
Well, I got into it because Harry Roberts, who was a statistics professor who I really admired, and Merton Miller, who was my main advisor, the two of them were my advisors, they were both interested in the work that was going on in describing price formation, trying to say something intelligent about it. And the people working in it, there were some at MIT, some at Chicago, they were kind of fumbling around the edges. They had no clear conception of what they were trying to do. So they were doing tests and saying, these are tests of market efficiencies, but they're basically said efficiency applies that prices are in walk. Well, but that was a very crude way of approaching stuff. So basically what I did was I started working on that because I knew it was a quick way to get a PhD because everybody there was interested in it. And I had 2 kids at the time and I had to get out quickly. So I started working, and then I've been doing it, I guess, more or less ever since. But basically what I added to it was a statement that what you're missing here is that you have to have some statement about what equilibrium looks like in this world. So what are expected returns? That had been totally left out of the picture. That's what I call the joint hypothesis problem. You have to say something about expected returns in order to say something about market efficiency. And that really set the world into thinking in that direction. And research exploded. So I say to everybody, well, I was there at the right time. That's what it comes down to. Nothing had been done. So everything you did was new. It was really very easy. PhD students now have it very difficult because they have lots of stuff they have to learn. And then they make a little play on the wrinkle, adding a wrinkle to it. Whereas when we were doing it early on, it was like shooting fish in a barrel. Nothing had been done. So
Well, now we're standing on the shoulders of giants like yourself, and it's amazing. It's somebody who's a young researcher. It's amazing to imagine just what it would be like sitting in a room with any of those people talking about financial economics and what hadn't been written down yet. It's really quite amazing. And I know before I get into sort of your body of work here, I know just another amazing story. University of Chicago that some people might know or might not appreciate is that the University of Chicago Booth School of Business gets its namesake ultimately from in part your thinking. 2 of your students, David Booth and Rex Sinkfield, they were students of yours in the 1980s, and they left to start one of the first index fund businesses, and brought you in as part of that effort, and ultimately, because of that success, David Booth made a very big contribution to the University of Chicago, and hence that's where it got its name from. So the Booth School of Business name in part is thanks to your ideas. What was that like, and could you explain to me a little bit about what the early days of Dimensional Fund Advisors DFA, which was founded by Rex Sinkfield and your students. What was that like, and being part of it since?
Well, Booth was my research assistant, my teaching assistant, when at the same time that Rex was in the class. This was an advanced class for PhD students and ambitious MBA students. And Rex took it all to heart and went off to American National and started really the first index funds based on what he learned in the course. And David, who was my research assistant and my teaching assistant, he came to me and finally after 3 years said, I see what you do for research. I've been helping you do it, and I don't want to do it. I want to go out and work. So I called John McQuan at Wells Fargo and got him a job, and he went off there. And then 10 years later, he called me. He said he wanted to start a business. And what he wanted to do was he had read all the recent work, and there was a lot of work at that time about how small stocks tend to have high average returns. And he said he wanted to start a small stock fund because none existed for institutional investors at that time. They had stayed away from that, and he wanted to start one. So that's how Dimensional Fund Advisors came about. And he said, I want you to be involved. And I said, well, I don't target my research at commercial products. And he said, well, you do what you do, and we'll figure out if we can use any of it. And that's basically the relation we've had with them forever. First me, and then me and Ken French after a while.
It's amazing. I mean, it's amazing how applicable financial economics is in the real world. And I remember you saying in the past that financial economics is the most successful area of economics. And I think if we're measuring success by application, I think that almost certainly in the sort of magnitude of impact, I think that's almost certainly the case. I can't imagine how finance, things like factors, things like the CAPM. Is someone who worked in finance, Goldman Sachs Asset Management for 5 years. I mean, all these ideas like CAPM beta or market beta. I mean, these things are just so fundamental to the practice of finance. And what's amazing is you've done so much work on this topic, and you've been so early to so many topics. I think, in my mind, you're one of the few people I think that would deserve 2 Nobel Prizes. And just to list a few of these ideas, like fat tails. We were writing about fat tails in the distribution of stock prices in your PhD thesis in the 1960s. The idea that stocks can have extreme events. And that was roughly around the time when Black Swan author Nassim Taleb was just born. You've written about event studies.
You're missing. Benoit Mandelbrot was the one who had that idea about the fat tails. He said everything in the world is fat tails. So,
wow, that's amazing.
Right. I mean, I applied it to stocks.
Even earlier.
I did not invent that concept of stocks. I got it from him. I applied it, but that was his idea, basically. Efficient markets I'll take credit for, but not fat tails.
We'll get to efficient markets in a minute here. But when I think about event studies, event studies, just in general, causal inference is swept economics as a discipline since the 1990s. But you were there in the 1960s, with Fama, Fisher, Jensen, and Roll in 1969, which sort of laid the groundwork for doing event studies. I think about the forward premium puzzle and carry trades. In 1984, you wrote a paper about the forward premium puzzle. The idea that currencies aren't necessarily obeying the uncovered interest rate parity, where the higher interest rate currencies are selling, that they're not actually selling off, as sort of theory would predict. And then you've done also a lot of amazing work in sort of the corporate finance, organizational economics theory of the firm kind of area too, and a lot of amazing things on like the stock market effects of buybacks, dividend announcements, agency problem theory of the firm, the idea that competitive markets naturally sort of align with managerial and shareholder interests. I'm just curious. I mean, all these greatest hits, many of these greatest hits are covered in a book called The Fama Portfolio, which is a great collection of your work that's edited by John Cochran and Tobias Moskowitz as well. But I'm curious, like, just taking a step back, how would you describe the overall theme of your work? What in your mind ties everything together? Is it risk-based asset pricing, diffusion of information, competition, dare I say, efficient markets?
Well, efficient markets is one. Like the logic underlying efficient markets would have a lot to do with the way, for example, Jensen and I looked at and markets more generally in terms of organizational markets and how they form and competition pushes them in a particular direction. So the idea of competition kind of determining how economies work in lots of different dimensions, that's basically the foundation of efficient markets and the foundation of lots of other stuff that I've done. But basically, I think I had a knack of going into areas where very little had been done and coming up with simple stuff that people related to. So I've always said that one of my best talents is writing in a very simple way so that the maximum number of people can understand it. And I teach that to my students. Some of them follow it, some of them don't. But I still think it's a good rule to go by in research. But anyway, I think I was in part lucky, and in part I had a pretty good nose for where good topics were.
Amazing. I mean, to say the least. I want to start by getting into efficient markets here and dive into it. So there's this joint hypothesis problem, which you talked about in your Nobel Prize lecture, and there's been sort of a big theme of I think a lot of your work. I mean, what led you to write your famous 1970 article, Efficient Capital Markets, and sort of what began this lifelong foray into being sort of a defender of the efficient markets hypothesis that says that stock markets are pricing information quickly? Was Mandelbrot at all an influence here? And what was your relationship with with Benoit Mandelbrot? I'm curious.
Well, I had a good relationship with him, but he wasn't the motivator for that. Basically, fat tails was his passion throughout his whole life. Fat tails of everything. The spillovers of the River Nile, everything, rainfall, everything was fat tails. So, and he was right. I think it was pretty much true. But that wasn't the motivation for the research that I was doing on markets, basically, and how they work, the economics of it. So that's where the joy hypothesis problem came up, and it's an unsolvable dilemma that you can't test market efficiency outside the context of some model that tells you what equilibrium expected returns look like. So you need a model of market equilibrium in order to test whether prices conform to that model. So when you do the tests, it's always a joint test. You don't know what you're rejecting, whether you're rejecting a model of market equilibrium or whether you're rejecting market efficiency. So that's the conundrum that this insight poses. But as a student of Harry Roberts, what I learned was there's no real truth out there. You're basically just trying to improve your description of the world. There's nothing that's really truth top to bottom. So you try to learn a little bit every time you do something, but don't expect that you learn everything or that you're anywhere near 100% right. Somebody's going to come along and improve on what you do. Maybe it's you, maybe it's somebody else, but somebody will do it.
I guess my understanding is sort of the joint hypothesis problems. It says that at some level, efficient capital markets is something that's difficult to test. But a lot of your work, though, is very empirical, and so I'm curious how in your mind does your work on, say, like looking at dividend buyback announcements and so forth. I mean, and seeing how prices respond immediately to these things. I mean, how do you think a lot of your work your empirical work specifically kind of advance this idea of efficient markets? I guess maybe just seeing that many of these events are sort of immediately incorporated into asset prices.
Well, that part of Fama, Fisher, Jensen, Roll was the first event study. There've been thousands of them since then, but we never did. None of us ever did another one. So the original four never did another event study, and now people do event studies. They don't even give us a reference anymore. It's so built into the literature. It's in macroeconomics, basically everywhere.
Applied economics everywhere.
It's in the law. For example, it's a fundamental way that the law people try to establish precedents in law. So it's everywhere. And
right, as you say, they're used in court cases, event studies. Right. I mean, it's amazing how influential it is, not just in academia and academic research, but also in the real world.
That's only half of it. So the other half is you have to have some statement about how prices get formed. You need a model of market equilibrium. And that's the other side of my research on asset markets, is trying to come up with models of market equilibrium that help us describe expected returns better. Some of it's worked well, and some of it I was really confident in, and it seemed to work in the U.S. and around the world. Seems to have basically disappeared or gotten a lot weaker. Maybe we killed it in the process of developing it and investors jumping onto it. But who knows? But anyway, that was the other side of the story that I've worked on basically continuously.
Good. Totally. Well, I want to dive a little bit into, I guess we'll talk about factors in a second here. But I want to talk a little bit just about sort of efficient markets versus behavioral finance. And often I hear, when I've heard yourself and Richard Thaler, who's sort of an emissary of the sort of behavioral finance school, that you've often, when you've been together on panels, that you generally agree on the facts, but disagree on interpretation. And I think you'd maybe take more of a risk-based or a rational lens versus Thaler, who takes more of, say, an irrational behavioral lens. I mean, I'm curious what you think about the legacy of efficient markets is, and what you think the legacy of say, behavioral finance is. I mean, there's been a massive rise in passive investing over the decades, which is a clear win for efficient markets. Obviously, DFA, BlackRock, Vanguard, all part of that. I mean, there's also these super successful quantitative hedge fund stories, Rentec, D. Shaw, some multi-manager. Then one could just argue that they're taking advantage of information. It's a rational story there as well, and maybe only a small pool of investors can do that. They provide liquidity, all these things. Now, alpha is a zero-sum game, net of beta, so they are doing active management that that outperformance has to come at the expense of some losers. But I guess separately, there are some investors out there that I guess use and hold up like momentum, and some claim that there's momentum factors. Those like your student Mark Carhart, and I think momentum is a pretty behavioral phenomenon. I mean, maybe some people argue there's momentum crashes, which are maybe compensated by risk. But how do you think about things like, say, the 1990s tech boom or Bitcoin? I mean, are bubbles real? I'm just curious how you think about these things.
Well, the way I think about them is you've got to show me, you can't just tell me that the market's inefficient. So Phil and I are great friends, and I have been criticizing him for many years, saying basically what you call, behavioral finance is really just a criticism of efficient markets. You don't have a theory of your own. It's just a criticism. And so I think you're just a branch of efficient markets, Julie. You're afraid to call yourself that. But so that he doesn't really take to that very well. But but the challenge comes. You can see like Bob Schiller, who I admire a lot, and he basically came up with a fundamental insight that said prices are much more variable than you can explain if expected returns are constant. So you have to have a lot of variation in expected returns to explain the variation in stock returns. Okay, that's fine. But then you have to tell me that something in there is irrational, either the variation of expected returns or the deviation of returns from expected returns. And they haven't got that far. They've not gotten that far. So again, basically, it's all just a criticism of efficient markets. And okay, fine. You're a sub branch of efficient markets then.
Very good. Yeah, I mean, it's and what you're referring to is Robert Schiller's observation that stock prices are much more volatile than the present discounted value ex post dividends. If you were to look back over the many decades or over the centuries, and you were to take the future dividends with the benefit of hindsight and to discount them back using discount rates would from that time, why is that value more constant than the actual stock prices themselves? And maybe it's something that you're using the wrong discount rate, I guess is maybe
just
one.
That the discount rates are varying through time.
Mm-hmm. Exactly.
On one level, that's almost a tautology. You're saying, okay, that will do it. That's true. But then have you got a story about what makes discount rates, expected returns, rational or irrational? And that's something about, well, what are the limits of a rational model of equilibrium? And that one still's waiting out there. We're still waiting for that one to get solved. I don't, either on the efficient market side or the inefficient market side, nobody's coming up with a really convincing argument there.
I mean, how do you think about these things like, I guess, the 1990s tech boom or Bitcoin? I mean, these things are extremely the tech boom.
I have a problem with Bitcoin. I have a real problem there. But
what's your problem with Bitcoin?
Well, Bitcoin is not a credible medium of exchange. My learning of monetary economics basically said if you're going to be the medium of exchange, you can't have a highly variable real value. And Bitcoin's real value is highly variable. So think of it as businesses don't want to do business in terms of a unit of account or a currency that's so highly variable, it itself can knock them out of business. They don't want to do that. So you don't expect that a medium of exchange that's highly variable in terms of its real value will survive. That's just classic monetary theory. So that's why Bitcoin gives me a problem. So I'm basically hoping it'll crash, that it will be a bubble. But the problem with other bubbles is they turn out not to be. You have to have a somewhat strange definition of a bubble to identify them. So, for example, stock prices were supposedly to have been a a bubble. And then it turns out they eventually went higher than they did when it was called who was the Fed governor, the Fed guy at the time that said they were a bubble. Anyway, but he turned out to be, prices did go down, but then they went up much more than they had gone down. So at that point, not just a bubble, it's just a random variation in prices. So
well, it's so interesting because, I think 10 years ago, there was, a lot of promises that Bitcoin was going to become more of a medium of exchange, that people would be using it to make payments regularly in the real economy, and that, I think, pretty obviously has not happened yet. So I think in some weird way, it's an asset that doesn't have any cash flows, and is just like, so in a sense, a purely speculative asset where it's only sort of worth what other people believe it to be worth, and obviously that can generate a lot of volatility if people's thoughts change. But it's interesting that all these folks, some folks have said that it's an inflation sort of hedge, and I don't think that's clear either, because in fact it doesn't seem to respond to bad.
It can't be an inflation hedge. It can't be an inflation hedge because its variance is too high. Inflation has very low variance.
Exactly. So even when you get a negative inflation print, it's not like Bitcoin rallies in response to that, but it seems to be very correlated with risk assets and stocks. So it's almost like this pure risk asset in a sense. So it's or it's becoming something like that based on this kind of idea that other people will value it at something in the future. So it's a very all of crypto, I think, is interesting or unique in this respect, and we'll see where it all goes. But particularly interesting. Same thing, I think, with other bubbles where there's, I think, often something, or what people would call bubbles. You often see either massive technological advances that don't pan out, or cases of fraud or other things like that. And I guess to be a bubble, you need a big, I guess, contraction, right, after some big run up. And so I guess you'd think the 90s tech boom, what happened there, a lot of promise.
Well, that was not contend that this wasn't a bubble, in the sense that enough companies survived that and got so extraordinarily big that was a good investment. But you just couldn't pick the winners. That was the only problem. But the activity itself, the idea that somebody was going to emerge from that time that would have a very high valuation, that turned out to be true.
We now have the Mag 7 stocks, or the Magnificent 7 stocks. Facebook, Amazon, and Google, and all those companies. It came out of that era. I guess not Facebook, but Amazon, Google came out of that era. I guess here's, I guess, sort of the next question really is getting into factors. And so I'm curious, what you think about, the so-called factor zoo. I mean, for one, 10 years ago, finance researchers spent tons of time researching asset pricing factors like size, value, the market factor, some interest in momentum, obviously the Fama French factors from your 1993 paper, size, value, in the market. I mean, now there's, I think, a lot of questions about those empirical asset pricing. It's much harder to publish, I think, papers about factors. And I think there's questions about the persistence of factors after they're published. Like size factors haven't worked as well in recent decades. The same with value. I think this has created a lot of challenges for value-based managers. I think, and there's some questions about sort of replicability, or maybe if a factor is published, it gets arbitraged away. I'm curious, what do you think about that, and just the legacy of, I guess, the Fama French factors from your 1993 paper? You have a more recent paper that you wrote in the 2010s that offers 5 factors. I'm curious what you think about that, this concept of factors to describe the behavior of stock prices.
Yeah. So when French and I got into this, basically we said from the beginning that we have to look and make sure they're robust. Did you see them not only in the U.S. for a particular period? Did you see them in the U.S. for periods outside the period that you use to identify them? And then you look around the world and you see if you see them in other markets. And that was the approach we always followed. So first we would expand the data in the US, and then we would look outside the U.S. And we only would, kind of consecrate something and say it was a real factor if it survived all those tests. And that was fine. But we also said, that once you get past the market factor, these more specialized factors have to have something else in them that causes people to be afraid of them and to let premiums move in that direction. And if people only aren't afraid of them, they can kill them. They can kill the expected returns associated with these factors. So we said that from the very beginning. And there's some chance that that's what actually happened. So we found that the size factor, the value factor, and people weren't afraid of small stocks, turned out. And they weren't afraid of value stocks. So maybe they killed it. I don't know. I mean, the problem is that these factors are buried in so much variance, you can't tell whether they're gone or not. So it's going to take another 50 years to come up with the right answer, and I won't be alive then, so we won't know.
Well, I know that, well, it's amazing. I mean, just to think too, I mean, we have, I guess, centuries of data now. I mean, some people have tried to take the CRISP data and go back further. I mean, were you a part of the creation of CRISP, the Center for Research and Security Prices? I know that's, I guess, one of the earlier sort of ideas or efforts to compile a lot of asset data, and that's been housed at the University of Chicago for a long period of time. I mean, to do, early research, pre-personal computers, I'm sure you had to do a lot of work to even just get stock price data. I mean, in those days, people were looking to newspapers still to look up stock price quotes often. I'm curious, like, how was that at all? How did that evolution work in terms of?
Okay, I was there, so I can tell you that one. Larry Fisher developed the NYSE tapes first at the University of Chicago, but they weren't ready when I was ready to write my thesis. They weren't even close to being ready. So I had data that I had collected as an undergraduate at Tufts on the 30 Dow Jones Industrials. So that was the data that I used in my thesis to develop both the fat tail distribution stuff and the efficient markets stuff. So I didn't use the CRISP data at all at that point. And then the CRISP tapes came along, and the research in that area exploded. But I'm not sure. What was this? Was that your full question, or did I miss something?
No, that's it. I mean, it's amazing. I think people don't appreciate. I mean, now everyone has computers and
right. Oh well,
high frequency data.
Okay, you're right. That's the other problem. So when I was even with the Dow Jones Industrials, you're dealing with a machine that has problems with any reasonable amounts of data. You're sticking cards into this machine and to put it there. And I used to go over in the middle of the night into the computation center and do my work because there was nobody there at that time. Me and another guy in the physics departments were the only ones there that we could have access to this machine that could do almost nothing and fill the whole room. But anyway, that's what I used with these 30 Dow Jones Industrials to do my thesis and follow-up work from it.
That's amazing. And just to think how, just empirical research has exploded since then. And I guess I'm curious just to, get back to this question of sort of factors and thinking about the structure of asset prices. So one, I mean, there's been a massive outperformance in the market factor, particularly in especially in U.S. equity markets in sort of the past decade or since the financial crisis, whereas other advanced economy equity markets have been generally flat for the past decade or so, comparatively, and maybe that's because GDP per capita has also flatlined in these sorts of countries. I mean, do you have any thoughts on the equity risk premium or why it's been so large compared to other countries? I mean, there's some people out there who say, well, quantitative easing is a big part of the story, and the Fed wasn't doing that before 2008. But what I would also say, would challenge people, and when people say that QE is responsible for the massive run up in the stock market, or massive run up in the stock market, and causing things like wealth inequality and so forth. I mean, other central banks around the world, the ECB, the Bank of Japan, they were doing just as much quantitative easing as a fraction of GDP as the Federal Reserve. So I don't really think that the story is QE either. I mean, the Fed buys a bond and it also issues reserves, and maybe is just sort of a wash as a result of that. But I'm curious, this massive outperformance of the U.S., is that just of U.S. equities, is that really a growth story in your mind, or do you have any other thoughts?
I think it's just a growth story, right? The fact that the U.S. won the growth story in that period of time. And in Europe, that had been doing very well, Japan, that had been doing very well, didn't do so well in that period economically. So stock returns are the highly leveraged claim on the output of the country. It's that's the explanation as far as I'm concerned, as far as I know.
It's just amazing to think. I mean, the idea that there would be so much divergence between the U.S. and other advanced economy countries. I mean, macroeconomists for a long time talked about divergence between divergence in general, which is really richer countries, advanced economy countries getting richer, while poor countries that presumably could import the same technology and the same ideas weren't catching up. And there's some degree of evidence that there's been a convergence across all countries in let's say the 90s and 2000s. I think since COVID, growth rates have gone back a bit. But I think there's this kind of new type of divergence that we're seeing, which is just there's the U.S. and everybody else and all the other countries. And I think a lot of that might have to do with technology. Why most of the largest technology companies in the world are all based in the U.S. And there's some story there. Maybe it's a long run institution story that the U.S. has always been a very good place to do business, or that these entrepreneurs came a long time ago and sort of set the seed, and now all the top talent from around the world wants to come to the U.S. I mean, do you have any sort of macro thoughts on why the U.S. has kind of won this race, if you will?
Well, that's a good one. We've imported lots of high-end people in the tech industries that have been instrumental in developing all these firms that have become massively profitable. I don't know if you have to go any further than that. So the talent wants to come here. If we can keep it that way, we'll be happy.
Yeah. Well, I want to talk about some newer theories that I think try and challenge efficient markets a little bit. And it's interesting because we're talking a lot about the 1960s and what the prevailing sort of theories were about what moved asset prices prior to the advent of modern finance, which is you've been a central part of developing, and a lot of that has to do with the role of information, expected future dividends, expected returns, and what's interesting is and obviously equilibrium, no arbitrage, all these things playing a big role in that. But what's interesting is prior to the 1960s, my understanding is that there was a big emphasis on supply and demand, and I think on supply and demand curves, kind of determining stock prices. And what's interesting is I think some of those ideas have come back. And there's a big debate right now about the slope of the demand curve for stocks. And of course, if markets were perfectly informationally efficient, I think the demand curve for stocks is perfectly elastic, or the demand curve is essentially totally horizontal.
I think true.
You don't think so?
No, of course not. I mean, all of stock market's no different from any other market. If resources pour into it and push prices up, expected returns are going to go down rather than other forms of investment. So it can't be perfectly flat. I mean, it's part of the overall list that the wealth in the world is limited. And if more of it goes into one asset than another, that asset's price gets bid up and its expected return goes down. So it can't be perfectly horizontal. Not at the level of the entire market.
Mm-hmm. Well, it's interesting because I think behavioral finance researchers, for example, like Andre Schleifer, he wrote a famous paper in the 1980s, that's titled, "Does the demand for stocks slope down?" And that is what happens if there's some flow, some exogenous flow into the stock market from, say, a big index rebalance like the Russell 2000. It reconstitutes once a year, and he would look at these index adjustment or index reconstitutions, like in the Russell 2000 takes out companies that have changed in their size over the year, and they add in new ones. They do it on a certain date, and that causes lots of flows from index funds in and out of certain stocks. And he looked at these stocks and argued, there's a reaction in stock prices, in that clearly quantities matter. And then he concludes that the demand curves for stock prices do slope down, but just a bit, in that these demand curves are still elastic. And we'll talk about what that kind of means. But in part, what it means is that elastic means that a $1 billion flow would lead to a less than $1 billion change in say the market cap of stocks. And I'm curious what you think about some of this even newer research on quantities. Like, for example, there's this new area called demand-based asset pricing. A lot of it's led by Ralph Koyan, who's a finance colleague of yours at Booth. And as part of his research agenda, he also has this paper with Javier Gebex that's titled "The Inelastic Markets Hypothesis." And we've spent some time talking about this paper before, and they essentially claim that the demand curves for stocks are even more downward sloping, that they're very downward sloping, and they claim that a $1 billion inflow into the stock market will cause a $5 billion appreciation approximately in market cap. That stocks are very, very, at the macro level, are very responsive to flows, and in part what they're trying to do is sort of get at the origins of financial fluctuations. What's causing financial fluctuations? So what they claim is that it's really quantities, I think, that are really driving fluctuations in asset prices. I think less so than just information. But I'm curious what you think about all this research that claims that quantities matter just a ton for stock market prices and determining them. And I think at some level it's a bit of an affront to modern finance and trying to go back to kind of this era prior to modern finance, which obviously plays a huge role on information, equilibrium, no arbitrage, and so forth.
Well, I'm not that familiar with that research. So, I mean, it comes down to are these effects permanent? Are these effects permanent or transitory? So if it's just a matter of trading pushes prices around temporarily, that's testable. There should be some part of the variance of the prices that's temporary that you can get out of, get around, and there should be trading opportunities for people who want to take advantage of this as well. So if it better be permanent, otherwise it gives rise to lots of profit opportunities. But I haven't followed it that closely, so I can't really comment on this.
I do think that so my understanding is that the inelastic markets hypothesis does claim that these effects are permanent, that a $1 billion flow into say the equity market, say someone takes money out of bonds or just they have $1 billion in cash and in their bank account, and they put that $1 billion, it could be a corporation or have you or investment manager, they put that money into the stock market. They say that's going to lead to a $5 billion appreciation in the total market cap. And
so
that's permanent.
That's possible. When you said earlier that the demand curves were flat, we don't really know how elastic they are at the aggregate level. When you're looking at the total shifts of total wealth between different asset classes, so we don't know what the effects are. And I think that's what Ralph is working on there. I'll have to go back and read that stuff a little more carefully. It's not that easy for me, but I'll do it.
Yeah, well, it's very interesting. I think and they look at things like flows into U.S. equity markets, and I think that there's some challenges too in terms of what's driving those flows to begin with, right? Are they truly exogenous, or is it just this great U.S. stock market run up that we've seen? Is that what's maybe causing the quantity in the first place? So I think it's a little hard to disentangle the two. and they use other strategies like granular and instrumental variables and so forth. I sort of have my own paper on this. It's sort of a tongue-in-cheek, titled the elastic markets hypothesis. It's sort of using country equity index additions and deletions, for identification. So you have big index funds, which from time to time, will have to take their money out of a certain country or put money into a country. Say the MSCI, Emerging Markets Index, say promotes a country into its index, and there's billions of dollars, or if not trillions of dollars, that follow that kind of an index, and using those for identification. So we don't really find that that prices are all that responsive to quantities, but that there is some response, and typically it's a bit more transitory and temporary than say something that would be a permanent change. But what's interesting too is, like, I think in the practitioner lens, there's a lot of these rules of thumb, like the sort of quadratic rule that when you think about things like transaction costs, when for example say you have some purchase of stocks, that it follows like this 3/2 function in terms of the market impact of a purchase. And so when investment managers are trying to think about what the impact of their own trades are, they use this model to sort of assume that going into the market and actually buying some stocks will have some effect. But they measure it, I think, pretty regularly using this sort of 3/2 this kind of quadratic type rule. But I think it's very much a transitory thing. I don't know. Have you ever thought too much about, say, transaction costs and things of that nature? It's maybe more of a practitioner.
I know. For example, that at Dimensional, they've always been very concerned about the effects of trading on prices, especially when they were in the small stock business. But they could never really find that there were lots of strong temporary effects in all the research that was done there. They never could find that. I never delved into it very much. They have a whole crew of PhDs that do this kind of stuff for them. But I was pretty well convinced that they were finding that the prices were, at least for individual stocks, were pretty elastic. They weren't that responsive to magnitudes of money going into them.
Yeah, and I think that's right. I think I do think that markets are pretty elastic, and there's lots of active managers that are trying to look at moments where things are maybe there's a bit of market impact from, say, some sort of a flow, or maybe there's these things like the Lipper fund data that tracks mutual fund flows, and this data comes out pretty regularly. I know a good number of bond traders sort of follow these sorts of things, or think about like month-end effects, for example. Like all the bond indices reconstitute at on the last day of every month. There's a paper I wrote with a co-author on how prices, how treasuries typically rally on the last day of the month, just because there's all these newly issued treasuries that don't enter the say big bond indices until the last day of the month. It's the same thing with stocks, right? And typically a lot of rebalancing happens at the end of the quarter, and so if there's big fund flows, maybe there's some empirical finding that there's a jump in prices along those days, but typically these things aren't that long lasting. They're temporary, and so the extent that they exist, sure, demand curves slope down a little bit, but not too much. And I think I agree with you there on demand curves being fairly elastic, but not perfectly elastic. And two, I think it's possible that elastic what efficiency is saying something really different, which is saying something more about how information gets incorporated, and that's different from demand too. In quantities, I think those things are a little bit different.
Oh, yeah, because Merton Miller always said, when information comes into the market, there didn't even be any trading, and prices adjust. Just the bid-ask prices adjust. So it doesn't really take trading to do it. Turns out it does take some trading to do it, as it turns out. But the information effects and And price pressure effects because relative demand shifts for different asset classes are two different things. Those are two different things. One's kind of a micro thing, and the other's a macro thing. So the macro thing is, I think, what Ralph and Gabex are interested in. And that one is an open issue, I think. We don't really know the answer there. They think they have it. And they're sure to attract people that will try to, substantiate what they're claiming. So we'll see about that one. Maybe right.
And other folks that may find like the contrary as well, and maybe that's really kind of the new efficient markets versus behavioral finance kind of a debate going forward.
That isn't though. That's just relative demand. Give me big shifts in relative demand for different asset classes. You're going to have price effects. How big they are is the issue. They could be big, they could be small. I really don't know the answer.
That's a great point. I'm curious. I have one last question, I guess, on just intermediaries and intermediary asset pricing. This has been, I think, a big new kind of area of research or renewed area of research in the, I think, years after the financial crisis. A lot of great researchers and financial economists, I think, have turned their attention to this. I think of folks like Daryl Duffy, Arvind Krishnamurthy, and Bismarck Jorgens, and many others who are particularly interested in the effects of thinking about things like fire sales that we saw maybe during the financial crisis, and who is the marginal investor, who is who's really determining asset prices, and there's a whole who's pricing on their kernel and so forth. I'm curious what you think about that sort of strand of literature and how you think about intermediaries, and in your mind, does the marginal investor matter in the determination of asset prices, or is everyone the marginal investor? I'm curious, how do you think about all of that?
I think everyone is a marginal investor as far as I'm concerned, because everybody's holding the stock is basically deciding instant by instant, implicitly or explicitly, to continue holding based on the prices or any asset. So everybody's a marginal investor as far as I'm concerned. I don't really relate very well to that literature.
And even like, I guess, a retail investor or so-called passive investor, you don't think that they're maybe less attentive and that would really matter? Or I guess retail investors are
so that's a different issue. We can't have 100% passive investing, that's for sure. There has to be somebody out there that's concerned about the prices being right. And there's somebody who makes money based on doing that. Otherwise, you're not going to get an efficient market. The market can't be efficient for everybody. It's efficient for me. Maybe it's efficient for you, but there have to be some knowledgeable investors out there. So, for example, insiders trading the stocks of their company, they have inside information. That's been well established. But otherwise, then they're also, I think, Ken French and I have a paper on mutual fund investing where we try to identify how much information there is out there that the mutual funds capitalize on. If you give them back all the money that they spend, fees and expenses, then you can see that there are winners and there are losers, and that they deviate from what you would expect by pure chance if none of them had any special information. And that's fine. I mean, they're helping to make the market more efficient. But
and I think that's the kind of maybe the insight of, I guess, Grossman Stiglitz, and I guess the idea is that that there always is some a bit of alpha out there, and that generates these there's always people seeking this little bit of alpha, and that there always has to be a little bit in order to make markets efficient.
Right. The question always arises: how much of that do you need to make it work? And the answer is, well, depends on how many bad guys there are out there, how many disinformed investors are out there, because they're the ones you have to offset. So you need fewer active investors if all the disinformed guys become passive investors. One belligerent active investor might be enough if all the bad ones drop out, but we'll never know.
Well, Gene, this has been an amazing conversation. I really want to thank you for coming on. It's been a real delight to talk about your career and ideas, and really just the this set of ideas that really began, at the University of Chicago, which you largely led in establishing modern finance. Really want to thank you for coming on. This has been a truly amazing conversation.
My pleasure.
This is the Capitalism and Freedom in the 21st Century podcast, an official podcast of the Hoover Economic Policy Working Group, where we talk about economics, markets, and public policy. I'm Jon Hartley, your host. Thanks so much for joining us.